Good morning and welcome to the Post-Monetary Policy Committee meeting press conference. The Monetary Policy Committee held its meeting yesterday, March the 29th, 2023, and today we have our usual press conference. In this one, the governor is going to give his statement, and afterwards you're free to put through your questions. And as is customary, you'll put your questions through on Slido. That's www.slido.com. The hashtag is MPC0323. Questions there, please make sure you include your name and your organization. But for now, we want to introduce and welcome the Governor of the Central Bank of Kenya, Dr. Patrick Njoroge.
Good morning, and great to have you with us today. The Monetary Policy Committee met yesterday to assess developments since its last meeting in January. You will already have seen the press release, and this briefing will give you additional background information for the decision. In the first instance, global developments. There was limited new data, in particular the WEU, that is the IMF's World Economic Outlook. They make the projections that we generally use, that most people around the world use. They haven't updated. The last update was in January, and we used those numbers when we, at the last MPC meeting, that is back in January. So there hasn't been an update. There has not been a new update, and we expect new numbers in April, April 11th to be precise. So, but there were high frequency numbers that we saw, and this in particular, the PMIs, for instance, and related data that show a strengthening of the production, and it's a global production in particular respects. At the same time, China reopened its production systems, so rather a reopening of China after the COVID period. And in a sense, you could say this is a victory for the world, that COVID is now almost firmly behind us. Inflation in advanced economies continues to linger, and we have a usual chart that we showed you last time, and you can see, for instance, in the UK, it's still up at 10.4%. The US, it's down to 6%. Euro area at 8.5%. So, in effect, the problems remain. Even though, of course, there has been some easing on inflationary pressures in those advanced economies. International prices of crude have also moderated. And yes, the slide over there shows you the moderation of crude prices. This is the one that we actually track, Maban. And you can see now it's at 78.8, but you can see it has remained well below 80 for quite some time. So this is obviously good news for us. In addition, global commodity prices have also declined. And this is a slide we have discussed before, looking at, for instance, palm oil. From the highs of 1,700 dollars a ton, I believe, per metric ton, back in May 2022, and now we are talking something like 950. It has really come back down. And then you have other things, maize, wheat, fertilizer, and in a sense, this reflects also, or would be reflected in the landed price in the various countries where, or rather the importers, Kenya and other places as well. At the same time, global supply chain disruptions are easing, and we had discussed this before. This is the cost of moving. It's an index really, but related to the cost of moving a 40-foot container in US dollars. You can see it had peaked at well above $10,000 for the 40-foot container, and now we are back again to more normal or more moderate levels below $2,000. So again, this shows how things are improving for all of us, and this is all good news. most important recent development relates to the collapse and rescue of a number of banks in the United States and also in Europe earlier this month. This is still playing out. And the concern that additional hikes to deal with the inflation that we mentioned in those advanced economies may exacerbate the financial stability concerns related to, as we mentioned, related to that may be connected with those banks and others in the entire banking sector. What is the bottom line? The bottom line for these things is that both problems, that is inflation and financial stability, are really separable. And there should be policies that are directed to each: inflation control and indeed also ensuring financial stability. But also, secondly, we need to watch financial stability. And in a sense, we need to watch this pot, lest it boils over. Thirdly, I think these results, or let's say these developments, they are really a vindication of strong regulation, supervision, and good practices, good risk management practices, etc. So, what we have from here. So, growth outlook in the advanced economies and indeed in the globally may not have materially changed. And this is the slide that we had before. We showed it to you last time. But anyway, it may not have materially changed. However, uncertainties have indeed surged. So the uncertainties in the advanced economies, and in particular related to financial stability, those have increased, and therefore we need to watch things carefully. Switching now to domestic economy, let's begin with growth. And again, here we say that there's no new GDP data that KNBS has released. We expect that they'll be issuing the first prints for 2022. They'll be doing this in April, the second half of April, and also will provide the usual information in the economic survey context, etc. But the bottom line here is that from our perspective, the economy is expected to remain resilient in 2023. In 2022, we are still estimating a growth of 5.6%. It is over there in the chart. But what we have done since last meeting in January is to again look a little carefully at agriculture and the developments in agriculture in light of let's say, the weather conditions that prevailed in January, February, and the first half of March. And consequently, we scaled down agricultural growth, which has brought down our projection for overall growth in 2023 to 5.8%, as you can see in that slide. Now, this is from the earlier projection of 6.1. But again, all driven by agriculture in the sense that we've scaled down agricultural growth in light of the developments that I just now alluded to. Activities in other sectors have remained strong, and I'll very quickly just go through the various slides, and you'll see this in the pack when we publish them. But just to show you that activity has been strong, this is turnover numbers in the wholesale and retail trade, and also in manufacturing sector. And you can see the green bars reflect growth rates. So, and this is sort of year on year. So you have 17% for manufacturing in January, and then 11%, etc. So you can see these are very strong growths. Power consumption, this is a good indicator, leading indicator for production in the manufacturing sector, and you can see the growth rates are back again in positive territory. The other numbers relate to cement manufacturers. There are tons of indicators on cement manufacturers, thanks to the questions we were raising before. And you can see here, at least in the turnover side, there is a robust growth. Consumption had been, you can see, had tanked in the second and I guess the third quarter, well, third and fourth quarter of last year, and you can see now it's coming back again strongly, quite strongly, well, maybe not as strong as we would expect, but as we would want. But I think the point here is that it is now resilient. Quickly on accommodation, this again strong developments. And again, this should be collaborated in the hotel sector in terms of tourism, in terms of, let's say, occupancy, etc. Finally, numbers on credit. This you can see credit growth at 12% really in February. It has come down a little, but I think it's still strong, and we will continue to monitor this. If you look at the various sectors where this is, manufacturing, trade, transport, and consumer durables, all of them you can see are in the double-digit numbers. And yeah, obviously we do understand it doesn't mean that more is better, is necessarily better, but I think the point here is that there is robust, it collaborates robust performance or resilience in those sectors. Moving on now to inflation. The numbers that we have today are from February. Where the February number was 9.3, 9.2, that is the dotted black line. And obviously it's come down from 9.6 in October. And of course we had projected that the inflation number, the headline inflation number, would be back in the target zone by Q1 the first quarter of this year, 2023. Clearly, it's not there. So the question is, what went wrong, if anything? Did we get our projections wrong, or what was it here? Having gone through it, and this is something that the MPC spent some time on to understand better what was behind this sort of development, and consequently align ourselves with how things would evolve in the next, let's say, 3 to 6 months. So the first thing, looking at this, is to identify that actually it was food inflation that actually was driving inflation. Here you have the blue line, the blue bars. And you can see that is way up at 13.3%. And within food inflation, we have vegetables, and this is the you can see the golden line, the golden bars there, or the golden splodges. So going from January to February, actually for the non-vegetables, inflation went down from 11.5 to 10.8. However, vegetable inflation went up. So their contribution there was 1.3 and went up to 2.5. So basically, we have identified vegetables as really the contributor of the, let's say, the variation that we saw from our projections. And if we spend some time looking at the other contributors, so of the difference of about 1.8%, or 1.9% percentage points, vegetables contribute 1.2 percentage points. And we also have maize products contribute about 0.2 percentage points. And then others, electricity is 0.2, and oil in terms of pump prices also 0.2. So that's really adding all those things together shows you that really, even as there were electricity and pump prices difference with our projection, the real driver was vegetables. So, but what happened with vegetables then? We missed it because of the abnormally hot and dry February and March, the first half of March. That's really what drove the prices of vegetables up. And it's collaborated, or it is, we got this from various sources, including the Agricultural Survey that we will be publishing, but also through other ways. So the drivers then of the main drivers of food inflation, you have the four main drivers, and wheat, maize, milk, edible oil, and you can see that has been coming down. So from 2.3%, actually from a peak of 3.4 percentage points to now 2.1. So even as those have been coming down, vegetables have really pushed things the other way, and it is just because of the hot and dry, abnormally hot and dry period that we just went through. So now monetary policy, of course, does not work directly on vegetable prices and things like that. So what did we do? We had a very good meeting with experts from the meteorological department. We met them the day before our MPC meeting. And it was, well, maybe a shout out to them. I really want to thank them for the work that they do. Maybe thankless, but I think it is, we learned a lot from them, and surely there's a lot that we can learn from the experts in any field, and in this particular case we did. Bottom line, though, is that they gave us assurance. So they gave us reasonable assurances that March rains were normal. Now we are at the end of March. And they expect that April and May, the rains in April and May will also be normal. And that is across the country. So basically, we got reasonable assurances that the long rains that we now have will be normal. Now, they also talked to us about the short rains. And the expectation is that this year we may have the El Nino effect. And of course, with El Nino, all bets are off in terms of how much rain and how much damage, crop damage, etc. So we go back to the El Nino issues, but I think in the short term, meaning the long rains, which are upon us, they have confirmed to us that this will, they have given us reasonable assurances that this will be normal. So I think this is really where we started off, and really therefore we would expect that the vegetables and all those quick growing products will come to the market fairly quickly. But there's something else we need to do here, which is to talk about the CEO surveys, the surveys that we did. And here we want to begin with the CEO surveys. This was actually possibly the most surprising of all surveys that we have had since we started off on these surveys. And really looking at it, this is a slide from the CEO survey, and we see that actually the optimism about business activity and economic growth prospects have actually fallen precipitously. You can look at the, let's say, the company, this on the left-hand side there, you have March, and you can see that the one that remains, well, I guess the green, which is that things will be lower, worse, has fallen from 9% to 26%. So it has gone up by that amount, yeah? And we haven't seen anything like this since the beginning of the CEO survey. And it is not just about the company. The CEOs talking about their own companies. They're also talking about the sector, meaning where they are. How is that sector? What are the prospects? And again, you can see that things will be worse, according to them. The people that, or the respondents, the percentage of respondents that say things will be worse has increased from 10% to 34%. That is significant. And we try to understand this a lot more. What do they ascribe it to? And they ascribe it to a few things. Inflation that they see, weakening shilling that, according to them, they saw, the drought, the prolonged drought, which they saw, cost of credit, and shortage of raw materials. Now, all these factors, there are also other factors, of course, that were present, Ukraine and the policies in advanced economies. But it is interesting that this survey was done before the rains came in. So it was done in the first half of March. And so the prolonged drought was still something that was very present in the minds of the CEOs. So what about markets? The market perception survey shows the same thing, a similar sort of outcome. And again, looking at the people that were very pessimistic, which is the yellow, but actually it is pessimistic, which is the silver one, that has gone from 8% to 23%, like 3 times. And I think and also in terms of the non-banks, also they are showing more pessimism. And again, the same issues sort of came up. And so from our perspective, this was quite surprising, and we therefore spent a lot of time understanding it and understanding how, what is the reaction from a point of view of MPC. So let's summarize a little. So the reduction or the fall of the optimism, and this is despite improvements in the external conditions and global prices. Secondly, there's this issue of timing. I talked about that it happened, the surveys happened before the rains arrived. And indeed also you could say happened before the protests that we have seen in our main capitals, in our main capital and in our capital, Nairobi, and also in some of the main cities around the country. And also a third element here is it was before we began to see a sort of a turnaround in the FX market that I'll talk about a little later. So what is all this? The lower optimism, one would expect that this would lead to delays in investment decisions. So investors, people who are building houses, etc., those decisions will generally be delayed when the investors are concerned in some ways. It also lead to poor operation of markets. So markets become more inefficient when in times of stress. And indeed also consumer confidence would probably also follow, meaning decline, which would lead to delays and delays in consumer durables, purchases of consumer durables, etc. It is against this backdrop that the MPC decided to firmly anchor the inflation expectations. So naturally, and the decision came through as an increase of the benchmark rate, the CBR, by 75 basis points, which was announced in the press release that we issued. Naturally, we stand ready to revisit this decision as more data comes to us and reveals inflation is well anchored in the target range. I then want to move quickly through the balance of payments, and I'll be very quick in this part because I generally spend a lot of time on it in previous presentations, so here I'll be rather quick. So on the balance of payments, exports, I think this is a slide that you are familiar with, but I wanted to put out to show just one thing here, or maybe 3 things. Tea the T in terms of the last 12 months to the cumulative 12 months to February was 1.372 billion from 1.2 billion, the year before, 12 months before. And manufacturing also performing well in that regard. And of course, horticultures finding their way. There was that whole conversation about specific products and what was holding them back. Things about specific markets, with regard to vegetables, fruits, etc., avocados, etc. But this seems to be bouncing back quite well. There was concerns before about tea, but this is a very detailed number, a very detailed chart. And I think the numbers we need to look at are more on the left-hand side, those darkish bars in terms of the average price. So you can see that the average price is coming back up, approaching 2022. Those are the dark bars. And then in terms of the, I thought there was a volume, but that's okay. So this is value in terms of kilograms of, here we are. So this is again tea exports. And you can see that our main importing countries are Pakistan and Egypt, and the values of those you can see have been much. So January to February is at the silver bars there, but the 2021. So the comparison is wrong. I have to be clear, because what you have there are the annuals, right? In 2021 and then 2022. But then you only have January, February for 2023. So there's a bit of issue there. But anyway, so be it. I wanted to say that there was some concern about Pakistan being unable to make payments on their imports. But that problem has now been resolved. We have been in touch with our counterparts there, and all those matters have now been firmly resolved, so no concern so much. And they are the standard sort of channels for purchasing, making payments, LCs, etc. All those are available in Pakistan for the purchases of tea, Kenyan tea. Moving along on imports, this is the cumulative for the period. I think the one to mention is, you can see, again, we've seen this before, but I think the one that is worth really looking at is machinery and transport, how much it has fallen. And this is because of the completion of the various projects that we had talked about even back in January and actually even back in November. Okay, so moving along, I think the point to make here is the current account. We'll just move directly to the current account. And the current account really, in 2022, this still remains at around 4.9% of GDP. And this is for 2022. There it is, the green one, 4.9. And for 2023, we are projecting 5.4% of GDP. That is the current account. And again, as we have said before, the sweet spot for us is around 5%. So this is definitely in the ballpark and shouldn't be a concern. On reserves, we can talk about reserves. Now we are 3.6 months of import cover. We are about 6.5 billion US dollars. And again, we have had a period when we have not been receiving significant inflows to the government, which is the way we accumulate our reserves generally. And now we definitely expect that these inflows will be coming in now that the government has sorted, let's say, whatever needed to be sorted in order for the inflows to come in. We are expecting about 200 million US dollars in very short order. We are expecting World Bank disbursement, something in the order of 1 1 billion, sometime by end April. We're expecting some more 400 million, along that same timeline. IMF money, as soon as they have come and done their review, so that should be by end June. The number we had for the IMF, actually, that will be scaled up for several reasons. One of which is the IMF has actually changed its policy temporarily, allowing for a 1-year period when actually countries can have higher access. In a sense, and that's a temporary policy for 1 year. And this is really a reflection of their accepting that their global safety net and things are quite tight for emerging market and developing countries such as ourselves, or frontier economies such as ourselves. So there's also other considerations, but I think I just want to stop on that. There has been the question about the Eurobond that is maturing in June of 2024. And this, the government has mentioned that they are working on it. The solutions for making sure that that will be repaid, so there shouldn't be any concern. But that is work that is ongoing. Moving on, maybe we move to the exchange market. We could look at the exchange rates. So this is the period March 24th, or rather January to date, 2023 to date. So you look at the various currencies there. You've seen this chart before. And so you can see we are, I believe that's what, 6.5? My eyesight is failing. So whatever I need to check, what is it? Here we go. Okay. So Kenya shilling is 5.8. That's what we have there, 5.8. I'm sorry, I couldn't read it. But anyway, it's 5.8. And you can see the other currencies, the other major currencies there. I think there's also another slide, a second slide. These are the major currencies, these are the African currencies. So still, you can see that we are pretty much in the middle of the pack. So even as people raise the question about depreciation of the shilling, I think the facts are here. Less hype and more data as is there. However, moving on this space, or in this space, the foreign exchange market, clearly we have talked about the various pressures that were there last year, and those questions have come up again and again. And yes, we have mentioned the point about the commodity price shocks that we have talked about, including particularly the oil prices. I'm talking of international prices, how those have surged. And then, of course, the negative sentiments from the Ukraine and all those other issues, even additional difficulties in importing things like wheat, etc. So yes, since last year, things actually worsened quite a bit, and I think we discussed this a lot. But what happened also, as we mentioned before, is that the volumes in the interbank market sort of fell significantly. And in the past, the interbank market was the market. But what happened is that banks, who are the ones that are supposed to be market makers, they had more pressures with their own clients, and therefore a lot of transactions were happening outside the interbank market. In a sense, that dried it up. So the point, of course, for us was to reactivate the interbank market. And in addition with that, we also issued a code to strengthen and provide long-term sustainability of the FX market. You've already seen the FX code that we issued. It's here, but it's on our website. This is, you have seen it, I'm sure, including also the press release that we issued. The point here is we are working with the market makers to re-anchor the market, that is the FX market in general, to the interbank, which will provide sustainability and indeed also offers this sort of pricing framework. So in terms of pricing of the FX market, let's say the currency, the foreign currency, will happen there in a well-functioning market, i.e. interbank market. So the FX code borrows heavily from the global FX codes and best practices from other leading jurisdictions. And we were pleased that the banks have welcomed it. They even issued a press release to this effect. And indeed, we are going to work with them. It is a sort of, let's just say, it's work in progress, right? So we set a standard and the code, and all of us, meaning the market makers, the banks, will have to work through time so as to assure themselves, assure the other market players, assure ourselves as the central bank that actually they are following the laid out principles and indeed the practices that are suggested in the FX code. So we are quite pleased with that. And in addition, of course, to all the conversation with the various market makers, we have also seen in the last 2 weeks a normalization of the volatility. So yes, the journey has started, and already you can see a positive outcome in terms of the re-energization, as it were, or the reactivation of the interbank market. We are on a journey. We need to move forward. A couple of things then about the banking sector, and then I'll leave it. Well, maybe I can see now we are well past 35 minutes, so I'll say a few things about the banking sector. This is stable and resilient, remains stable and resilient. There's liquidity, there's capital, and at the same time, we realize that the NPLs to gross loans, as a ratio of gross loans, has increased to 14% in February. This is from 13.3 in December. And again, it is because of the difficulties that some of these, let's say, borrowers are having in their own sectors. So these are sort of the economic difficulties, which one can also say relate to the responses that we received from the CEO surveys and also the market perception survey. Of course, we expect that the banks and the borrowers will work to minimize, to work to ensure that actually the borrowers remain current as much as possible in their loans. And that we don't expect that, or rather, we do expect that there may be possibly even an increase as given the difficulties that were indicated to us from the various surveys. But I think the point here is that that will sort itself, will reduce, will fall as the situation normalizes. There has also been consolidation and strengthening of the banks, of the banking sector. The most recent was the purchase of a significant shares or significant portion of the shares in FCB, First Community Bank, by Premier Bank of Somalia, which also is good for us because it means that we are establishing banking links with our neighbor, and one can expect that with time, particularly when they enter the East African community, it will be beneficial for everyone in that space. We have continued work on the digital credit providers, and we approved another 10 of them. And this is work that we need to continue thorough and indeed, well, maybe even painstakingly. But anyway, it's something that needs to continue being done, and we'll continue with that. Finally, I think there's I would want to mention about the CSD, and this is the Central Securities Depository. We mentioned it, I guess, a month ago, about a month ago. And basically, this will be our Central Securities Depository through which all T-bills or T-bonds are not only registered, but you can access them and you can purchase, etc. So there will be a significant, let's say, refresh and indeed step forward in this space, allowing virtually anybody in Kenya to purchase T-bills from your phone, and indeed other things. There are other benefits, including liquidity management. But I think the point here is that it's something that has been long in coming, and will address some of the, let's say, pressure points, yeah, that have been addressed, or that has been coming to us all the time. For instance, our diaspora complained that they, in order to purchase, to invest in T-bills, they have to come to the central bank, etc. So they'll be able to do that, to purchase, invest, etc., from the comfort of their homes, wherever they are. So now we are finalizing the data migration on this, and it is critical work. And we have to finish it and prove that it is 100%. That is 99.9% isn't good enough. So it's 100% accurate before going live. So we expect that this will happen sort of the second half of April after Easter, etc. So in the second half of all that. But I think the point is there'll be announcements as we move forward. I want to stop there and take your questions. Thank you very much for your attention.
Thank you, and the questions are coming in thick and fast. Reminder, send them through Slido, SLIDO. The hashtag is hashtag MPC0323. So we begin with Davis Ombane. Davis is a student at the University of Nairobi. He says, Kenya's foreign exchange code by CBK is timely and commendable. From your assessment, has the code brought any calm in the financial markets? What is the impact of the government-to-government arrangements to purchase oil in credit to our current state of foreign exchange reserves figures? Next question is from Kefa Moirore, who is now at the Business Daily. There's been a renewed push by BRICS members, that's Brazil, Russia, India, China, South Africa, to end the dollar hegemony. On which side of this debate would the CBK sit in breaking the dollar hold? Last one in this batch from Brian Guge, who's now at the Standard newspaper. Brian's question is, what is the latest update on the plan for the split or separation of Safaricom's M-Pesa units from its telco business?
Okay, thank you. So taking them in turn, as I mentioned, the work that, the code that was put in place, and also the work that we have been doing with the various market makers, that is the banks, has actually been highly beneficial. So over the last 2 weeks, there has been a reduction in volatility. In a sense, the river is coming back to its course. And that obviously will continue to, let's say, to reinforce itself. So again, as I said, we are not at the end of it. This is a journey. And it is important that we stay the course. So yes, there has been improvement, but I think we also have to appreciate that it's a journey, and we have to maintain hypercare in this space. Yes, there was the announcements of the oil purchase, the government-to-government purchase of oil, and I think this is something that obviously we mentioned is commendable. Right? What it will do is, at least for the next 6 months, to have less demands in the spot market. Because in the past, actually, in the past, oil marketers would actually purchase dollars in the spot market. So there will be additional pressures in the spot market as they source those dollars. So the point is that this will obviously, in the next 6 months, there will be less there'll be less demands on the dollars because this is a long-term sort of arrangement that will support this and will mature in a long-term sense. My understanding is 6 months, but it could be even longer. So I think that will also be beneficial. Again, it is not one aspect that resolves everything. And I think this is something that we have all understood. You don't resolve, and even most medicines, you generally don't get just one medicine that will solve the problem. You generally have a cocktail of things. We are kind of complicated machines, hence the need for a cocktail of things to resolve issues. Kefa's question about this renewed push by BRIC members to end dollar hegemony. Yes, this has been there for some time. But I think the point here is it has come back again, again and again. And I think the issues will continue to come back and forth. Now, you should understand that what has pushed it now is not just the concerns that maybe you are alluding to. It's also the concern about the dollar liquidity in the system. And if you remember, the advanced economies have, and in particular the Fed, subsequent to the decline, to the collapse of the banks that we mentioned, SVB, that's Silicon Valley Bank, the first is Signature Bank, and also First Republic, all those banks in the U.S., and indeed also the Credit Suisse, there was a significant sort of need for dollar liquidity. And those banks, those central banks actually put out a lot of liquidity. They actually created it's been there before, but they used to auction dollar liquidity every week. Now they're auctioning it every day. And actually the sourcing of that is an all-time high. So yes, it's not just because we want to protect ourselves and stay away from the risk, because actually the dollar is becoming harder to get. And I think with time it will resolve itself, but the concerns will always be there. So what is the answer here? Sure, there will be all these pressures, but remember, a lot of this is long-term. You cannot resolve these things in short term. And we know this ourselves. Why? Because in the East African community, we are actually trading in our own currencies. We are trading in our own currencies. This is through the IP system. And if you recall, we signed an agreement 2 weeks ago or 3 weeks ago in Burundi to reactivate, to re-energize this sort of trading using our own local currencies. So it's something that we are very familiar with, and but I think the issue here is let's not look at it as a sort of a quick fix. There's a lot of details that need to be put in place, and again pushed by other reasons. Brian's question about the plans to split and separate Safaricom. That is ongoing. We had a conversation with them, and they have to. I don't want to say where they are now because it's probably better for them to talk to you. So please, Brian, ask them to explain to you where they are. But again, as I say, in terms of progress, they are making progress, and yeah, we hope to see the fruits of their work in short order.
Right, from Kefa Moirore from the Business Daily, kindly offer an update on the outcome of the credit repair program that is expected to lapse tomorrow. That is the number of beneficiaries and recoveries made by the banks. Herald Alor from the People Daily. He asks, how is CBK projecting Kenya's foreign exchange reserves levels in the next 1 or 2 quarters? If expected to improve, by what margins? David Herbling from Bloomberg News. He says 2 banks, that is Chase and Imperial Bank, collapsed on the first year, and most recently, you rescued Spire from collapse. Is the Kenyan banking system facing a systemic risk?
Fine, thank you. So, Kefa, again, your question about credit repair. I don't know about what you say here, that it lapses tomorrow. The framework expires on May 31, 2023. So, unless there's something you know that I don't know. But it has been working fine, so it's still working through their system. For those that need to be reminded, basically what this was about were people that had borrowed the digital loans and basically had therefore been flagged as non-performing because their loans were non-performing, indeed were, and indeed flagged as such in the CRB, the credit reference bureaus. So it was really intended to repair their credit status after they've cleared their dues with the lenders. And so what happened is they were offered a discount, and once they got agreement with the bank, then they went ahead and began making good on those payments. And if they were doing that, then obviously they'll be current, and therefore their names their status in the CRBs would also be revised to reflect that. So this is ongoing, and I guess we'll tell you more about it as we get to the end of it. But I think what I would say in finishing on this is that actually it was very well received by those that were affected by it. Now, of course, there are some problems with fixing it, and I think we can discuss that at the end of it once this has been sorted. About projections of foreign exchange reserves, I think I mentioned the inflows that are coming in. So you can add those inflows, and then you can also imagine that we are making payments. So it's really, I don't have the final numbers here, but we do expect that we'll be in a healthy position, or rather our position will be strengthened, not just in the next 1 or 2 quarters. We are talking of in the next month, 2 months, by the end of June, and definitely by the end of the year. So I think that is something that, and that's why in our weekly we say that we are in a comfortable position, and it offers us the assurances that we would want to have. Helbling asks, well, bottom line of his question is, Kenya's banking system facing a systemic risk? The answer is no. It is not facing a systemic risk. I think I explained that it is well capitalized, and also there is liquidity. I did mention that in the context of the beginning when I was talking about the US, I did mention the vindication of good regulation. Yeah. And if I were just to repeat what I said, the vindication of strong regulation, supervision, and good practices. All those three work together. So I think this is what we've done in the last 7-8 years that we've been working in this space, and we are happy that the fruits are there for everybody to see. What else?
Another batch of questions. Standard Investment Bank. She asks, why a 75 basis point hike? Advanced economies have done a maximum of 50 basis points. So do you foresee high inflation rates than were recorded in 2022? Eric Mokaya from Wango Capital. There have been reports of the reopening of the interbank foreign exchange market. What is the current state of that market? And then Otiato Buguyu, who's now at Maudhui House. You noted that credit demand and supply are on a decline. Do you see credit dropping to single digits on the CBR tightening?
Okay, so why a 75 basis point hike? This is what Stella is asking. Maybe I would ask why? The point here is that it's a balance in many ways. There's no sort of, you want to call it crystal ball that gives the right answers. It's all judgment and balancing a lot of the elements that I mentioned before. It is true the advanced economies are doing their thing. And what we cannot do is to slavishly follow another central bank. Why? Because they have their own specific things. I spent a bit of time making the point that really vegetable prices or inflation is what has pushed us quite far. Now, again, I mentioned that it's impossible to really direct monetary policy to vegetable prices. What you direct it to is a sort of the second order effects and through things that are interest rate sensitive, etc. So I think the point here is that it was balancing act, balancing several factors which I outlined, and also understanding the idea of keeping, the whole point is to anchor inflation expectations and to ensure that inflation expectations don't run away from us, don't get unanchored. If indeed inflation expectations, for whatever reason, or let's just say if there's some sort of lack of credibility in the central bank, whatever it is, then of course, you'd be pushing on a string, and that wouldn't be sufficient. So it's not that we foresee higher inflation rates than what was recorded. No, it's not that. There's just looking at it and seeing. I also mentioned that on the CEO survey, there are concerns about inflation. The protests that we see, the concerns are cost of living, that is inflation. So I think it is important for us to realize that we are doing what our mandate requires us to do. Then there are this thing of the interbank market or reopening. I think I explained this, that it's not that reopening, but rather reactivating. So there's more vibrance in there. So there's more volume going in there, in the interbank market. And what has happened also is there has been a reduction in the volatility. So you could say that the prices are coming around a central numbers. So again, a central tendency, if you may. So this is something that we expect, but actually something that we need to sort of, let's say, treat with hypercare to make sure that actually it fully embeds itself in the market. I don't know when I say that credit demand and supply on a decline. I think what I was talking about is the growth rate, right? The growth rate on the credit, private sector credit, which has come down marginally. But it is still positive, it's still in double-digit numbers. So I wouldn't say it is on a decline. So I think the issue here is not to worry too much about. Well, it's true the increases in the CBR rate will transmit also in part through interest rates the entire sort of let's say interest rate structures in the economy. So, and that obviously necessarily will lead to a tightening or reduction, if you may, of credit. But I think the point here is that also is that takes time. That takes time to work itself. And I have mentioned before that it takes a bit of time for the MPC decision to filter through the economy due to the transmission lags that are there, right? So, for instance, it takes something like 3 to 8 months for the impact of that MPC decision to impact or to affect credit to private sector. So 3 to 8 months. So you'll have to wait that long, before you begin to see it taking initial sort of reaction. And it takes as long, well, it takes maybe this much as well, that much time, 3 to 8 months before it begins impacting on real GDP. So those are the transmission sort of estimates that we have, and obviously we use it in determining in that judgment as to where is it that we're going to set the MPC or the CBR. Next, please.
The final batch of questions will begin with Giovanni Riva from Red Intelligence. This is market intelligence. I understand that Kenya's accelerating currency depreciation amid shrinking foreign exchange reserves is driven by dollar shortage this time around and might force central bank to devalue the currency before the end of the quarter of 2023. Do you want to comment on that? Gideon San from Saiton Investments is asking, how are you addressing the disparity in exchange rates? What steps are you taking to ensure adherence to the FX exchange code? And the final question is from Brian Gugio, the Standard newspaper. What are the reflections on your tenure? Have you accomplished your goals from monetary policy, regulation, consumer protection, transparency, and independence?
Okay, so starting with the first question, I think, Giovanni, your question, I think, reveals some issues that we may need to set right, okay? When you say that the central bank will devalue, you know we have a flexible exchange rate regime. We don't determine the value of the shilling. So unlike other countries that you may be familiar with. So I would encourage you to sort of do some work and understand how our foreign exchange market works, our FX policy, exchange rate policy, etc. So now you mentioned currency, accelerating currency depreciation. Well, I gave you the numbers. I don't know if that is 5.8% qualifies as accelerating currency depreciation. I talked about the foreign exchange reserves, and I told you why they are where they are. We use our foreign exchange reserves to make payments for government, so paying on their debt, etc. So that's really what I can say, Giovanni. So I encourage you to sort of understand how is it that we are different from other countries that you may be more familiar with, that actually, would do some of the things that maybe you are suggesting here. Gideon asked disparity in exchange rates. I thought I explained all this, what we are doing. I mentioned the point that, now I don't know about the disparity in exchange rates. That's a plural, I don't know what that means. But I think I explained that what we've been trying to do since what happened to be, let's say, the dislocations that we saw in 2022. And we've been trying to address them. The directions, the broad directions are twofold. One, re-energizing, reigniting, reactivating the interbank market so that the transactions actually happen around that. And the second is the FX code that we have. Again, it is the foreign exchange code that will allow us or will provide with assurance about the actions of each of the market players. And, the example I have here is, you and I could decide to drive to Mombasa, okay? Now, and all of us, let's say, are 10 cars going to Mombasa. We could all carry some, a tank of one of these jerry cans of fuel. All of us, each one of us. And that assures us that we are going to have fuel for the journey. But you can imagine that that is a very inefficient and indeed kind of dangerous operation. So what we do is we sort of say, actually there are petrol stations along the way. And we can actually stop by, top up, check our engines, and then continue. And that is really the analogy of the interbank market. So yes, without the interbank, everybody is trying to resolve their own issues with the banks, in a sense, very inefficiently. But if everybody is working through the interbank market, that is sort of like the gas stations. You are sure that if you need it, it's there. and therefore everybody has a safe way forward in that sense. So it is you could say it is a good equilibrium. The other one is a bad equilibrium, and it is an equilibrium nevertheless. So we are pushing us from the bad equilibrium into the good equilibrium, where the interbank market plays the most important role in terms of pricing and, of course, distribution of foreign currency to the purchasers. Then the last thing, Brian, reflections. My tenure is still going on, so maybe these questions apply, but they apply after the tenure has ended. So that's all I'll say for now.